Have you ever stopped and wondered, why did my home loans suddenly get more expensive? Or why did the price of everything at the grocery store just jump up? Well, today, we're going to pull back the curtain on the powerful institution that's pulling a lot of those strings, the Reserve Bank of India. Let's dive in. So let's just start with this one big question, right? A question that honestly affects pretty much all of us. Who is it that's actually calling the shots on whether your car loan or your business loan gets cheaper or more expensive? You might think it's just your local bank manager, but trust me, the real decision maker is way, way bigger.
You see, you have to think about the entire economy as this giant balancing act. It's kind of like a seesaw. On one end, you've got economic growth, more jobs, more businesses, and on the other, you've got stability, predictable prices, a safe financial system. The whole game is to keep that seesaw perfectly level, but it's always, always at risk of tipping over. And this is exactly what happens when that seesaw tips. If it tips toward a slowdown, well, that means low growth, rising unemployment, people start losing their jobs, and nobody's spending money. But if it tips the other way into high inflation, the price of everything just skyrockets, and the money in your wallet suddenly buys a lot less. Yeah, neither one of those is good news. So, who's in charge of keeping this whole thing balanced? Who's the one trying to stop the seesaw from tipping over? In India, that job belongs to the Reserve Bank of India, the RBI. You can think of them as the economy's conductor, working behind the scenes to make sure all the different parts are playing in harmony. And their job is absolutely massive. Now, the government handles its own budget stuff through taxes and spending. We call that fiscal policy. The RBI, on the other hand, is in charge of monetary policy. They control the money supply. They literally issue our currency. They act as the government's bank. And they regulate all the other banks to make sure the whole system doesn't just collapse. They're basically the top dog of our entire money system. Okay, so when that economic seesaw starts to tip one way or the other, what does the RBI actually do? Well, they've basically got two main playbooks they can run. They can either go down the easy money path to get things moving again, or they can choose the tight money path to cool things down.
And here you can see those two game plans side by side. If the economy's slowing down, the RBI goes for an expansionary or easy money policy. The goal? Lower interest rates, make it cheaper to borrow, and get people spending again. But if inflation is the big problem, they switch gears to a contractionary or tight money policy. They raise interest rates to make borrowing more expensive and slow the whole economy down. Let's follow the dominoes on that easy money policy, because it's like a chain reaction. The RBI lowers key interest rates. That means borrowing becomes cheaper for everyone. This encourages businesses to invest in new projects and you to maybe buy that new car. All this activity fuels economic growth. And here's the best part, it creates more jobs. Now let's flip it and look at the opposite. With a tight money policy, the RBI raises rates. Suddenly, borrowing gets more expensive. That discourages people and companies from making big purchases or investments. This reduces the overall demand in the economy, which then helps to bring those rising prices, that inflation, back under control. It's like gently but firmly tapping the brakes on the economy. Okay, so we've got the why and the what. But how? How does the RBI actually do all this stuff? Let's take a peek inside their toolbox and look at the actual instruments they use to make these policies a reality. All right, first up, the big one, the repo rate. You should really think of this as the wholesale price of money. It's the interest rate at which the RBI lends money to all the other commercial banks. So when the RBI changes this one rate, it sends a massive signal through the entire financial system, and that eventually changes the interest rate on your car loan or your credit card. Another really powerful tool they have is the cash reserve ratio, or CRR. This is just a fancy way of saying it's the percentage of a bank's total deposits that it has to park with the RBI. It can't touch it. So if the RBI raises the CRR, banks instantly have less money available to lend out. It's a way to tighten the money supply without even touching the main interest rates. Pretty clever, right? And then you've got these things called open market operations, or OMOs. Now, I know it sounds super technical, but the idea is actually simple. The RBI acts like a giant vacuum cleaner for money. It can either inject cash into the system by buying up government bonds, or it can suck cash out of the system by selling them. It is the most direct way they have to manage the total amount of money floating around in the economy. So here's a quick look at how that works when they want to inject money. Step 1, the RBI buys government bonds from the banks. Step 2, the banks get cold, hard cash in return. Step 3,
All of a sudden, these banks are flush with cash, which means they can lend a lot more money out to people and businesses. And just like that, the money supply in the whole economy goes up.
So we've talked about all these high-level policies, repo rates, OMOs, but why should you actually care? Let's connect all these dots and see how these big decisions made in Mumbai find their way right into your wallet. The ripple effect is literally everywhere. When the RBI changes that repo rate, your home and car loan EMIs can change. When business loans get cheaper or more expensive, that directly affects whether companies are hiring, which impacts job creation. And of course, the RBI's ongoing battle with inflation determines how far your salary actually goes each month. So that's the traditional playbook, right? That's how central banking has worked for a long time. But what happens when money itself starts to change? Because over the last decade, we've seen a digital payments revolution in India that is changing the very plumbing of our financial world. A lot of this transformation has been driven by the National Payments Corporation of India, or NPCI. These are the folks behind total game changers like UPI, which kicked off in 2016 and made paying from your phone instant and easy for millions. They also built RuPay, India's very own card network. They've fundamentally changed the speed at which money moves. And this digital explosion brings up some really fascinating questions for the future. With real-time data on every single transaction, can the RBI make faster, smarter decisions? Will new digital currencies change the role of a central bank altogether? That economic balancing act is only getting more complex, and the RBI is going to have to adapt to a future where money isn't just paper anymore. It's data, flowing at the speed of light.